Today is Sunday, January 25th, 2026, so the stock market is currently closed. The most recent trading session for Rezolve AI, ticker symbol RZLV on the NASDAQ, concluded on Friday, January 23rd, 2026 at 4 p.m. EST. At the close of that session, the stock price was $3.14, representing a significant intraday decline of 8.99% from its opening price of $3.40. Throughout that Friday session, the stock fluctuated between a high of $3.42 and a low of $3.11, with a massive trading volume of approximately 44.2 million shares. This level of activity is a sharp contrast to the typical quiet Friday and suggests a market that is deeply divided on how to price the latest massive capital injection the company just secured. The immediate expectation for Rezolve AI was a period of consolidation after it announced a staggering $250 million registered direct offering. Most investors believed that such a substantial capital raise, backed by heavy-hitting institutional players, would act as a floor for the stock. Reality, however, has been much harsher. Instead of a celebration of liquidity, the market reacted with a wave of selling pressure that saw the stock plummet nearly 23% in a single day earlier this week, followed by the continued slide we saw this past Friday. This creates a fascinating curiosity loop for anyone watching the AI sector. Why would a company that just secured enough cash to fund its operations for the foreseeable future and has guided for a massive $500 million exit run rate by the end of 2026 see its market value shrivel? The answer lies in the tension between the long-term potential of their brainpower technology and the immediate reality of share dilution that existing retail investors are currently forced to swallow. If you look at the broader sentiment, many traders on social media and on investing sites are focusing on the dilution narrative. They see the $250 million raise as a signal that the company needed cash faster than it could generate it from sales. But I want to challenge that common belief with a deeper, more contrarian take. When you look at the institutional activity, this wasn't just a desperate grab for cash, it was an oversubscribed round. Fundamental institutional investors don't pile into a sinking ship at a discount unless they see a path to a much higher valuation. The reality is that Rezolve AI is moving from being a speculative AI play to becoming an enterprise infrastructure provider. While the price action looks ugly on a 5-day chart, the balance sheet is now one of the strongest in the small-cap AI space. We are seeing a classic transfer of shares from weak hands who are scared of short-term red numbers to strong hands who are looking at the $350 million revenue guidance for 2026. The recent movement has been nothing short of a roller coaster. Just a week ago, RZLV was testing the $4.60 range, buoyed by the excitement surrounding their partnership demonstrations with Microsoft at the NRF 2026 event. Then the news of the $250 million offering hit. In the world of online investing, a direct offering is often a double-edged sword. It provides the fuel for growth, but creates a temporary surplus of shares that outstrips immediate demand. We saw trading volumes explode to nearly 87 million shares on the day of the announcement, which is astronomical for a company of this size. This volume indicates that a massive rotation is happening. If you are using platforms like Interactive Brokers or the Robinhood app to track these moves, you've likely noticed the high volatility index for RZLV. The stock is currently trading nearly 60% below its 52-week high of $8.45. Yet it remains over 200% above its 52-week low. This is the definition of a high-stakes battleground stock. Institutional activity is the secret sauce here. While individual brokerage accounts might be seeing red, the filing data shows that the offering was led by fundamental investors. This is a critical distinction. These aren't just hedge funds looking for a quick scalp. These are entities interested in the agentic commerce narrative that Rezolve is building. When you have partners like Google and Microsoft already integrated into your ecosystem, the reality of the business starts to look much more robust than the expectation of a failing SPAC-era company. The market is currently struggling to value the 95.8% gross margins the company reported in its recent H1 figures. Those are software margins that even NVIDIA stock investors would envy, but they are currently obscured by the negative $17.7 million adjusted EBITDA loss. The market is effectively asking, can you turn these high-margin API calls into actual net profit before you run out of this new $250 million? Comment below how many shares of Rezolve AI you currently hold, or if you're waiting for a dip below the $3 level before entering. To understand why this stock is so divisive, we have to look at what Rezolve AI actually does. They aren't just another chatbot company. Their core business model revolves around a proprietary large language model called BrainPower. This isn't a general-purpose AI like you'd find in a basic consumer app. It is a specialized, compact model trained on over 300 billion tokens of commerce-specific data. Their Brain Suite includes Brain Commerce and Brain Checkout, which allow retailers like H&M and Urban Outlets to turn a simple image search or a conversational interaction into a completed transaction instantly. The goal is to eliminate the friction between seeing a product and owning it. This is what they call Agentic Commerce, AI that doesn't just talk to you, but actually executes tasks, like finding the exact pair of shoes from a blurry photo and checking them out using your saved preferences. The company's growth has been objectively explosive, even if the stock price doesn't reflect it today. In the first 8 months of 2025, their infrastructure powered over 1.6 billion search sessions and handled 13 billion API calls. That is a massive scale for a company that many investors haven't even heard of yet. They have reached over 53 million consumer devices through their SDK. This is the reality that is currently exceeding the expectations of the broader market. Most analysts were expecting much lower engagement numbers, but the enterprise adoption has doubled since June. The business model is a classic SaaS play. Charge per API call or per transaction, which leads to that 95% gross margin. They are essentially building the plumbing for how we will shop in the late 2020s. When we look at the future outlook, the catalysts are clearly defined, but come with significant risks. The biggest upside catalyst is the 2026 revenue guidance. Management is calling for $350 million in revenue next year, which is nearly double what the market was expecting just a few months ago. If they even get close to that number, the current market cap will look like a clerical error. However, the risk is execution. Scaling an AI platform to handle hundreds of millions of transactions requires flawless technical performance and a very aggressive sales cycle. They are competing in a world where every major tech player is trying to grab a piece of the AI commerce pie. While BrainPower has shown it can outperform GPT-4 in specific commerce tasks with zero hallucinations, Rezolve doesn't have the brand recognition of a household name yet. For those of you managing your own portfolios through Schwab Intelligent Portfolios or self-investing on a Fidelity trading platform, RZLV represents a classic high-reward, high-risk moonshot sleeve. It's the kind of stock that requires a deep understanding of the underlying tech rather than just looking at a PE ratio, which currently doesn't exist because they aren't profitable yet. The expectation is that the $250 million will last them until they hit cash flow positivity, sometime in late 2027 or 2028. If the reality matches their guide of a $500 million ARR exit run rate, we're looking at a company that is currently being valued at a fraction of its future potential. Comparing this to the giants, while NVIDIA stock provides the hardware and Apple stock provides the hardware-software ecosystem, Rezolve is trying to provide the specific intelligence layer for the retail vertical. It is a much more focused bet. If you are looking for investment help or exploring various investing sites to see where the next big thing is, the focus should be on these specialized AI models. The general-purpose LLM market is becoming a commodity, but a model that can perfectly identify a product from a grainy video and handle a multi-currency checkout is a much rarer asset. That is the moat Rezolve is trying to dig. In summary, the central insight here is that Rezolve AI is currently in the middle of a massive identity transition. The market is treating it like a dilutive small cap that is burning cash, while the underlying business metrics suggest a rapidly scaling enterprise software powerhouse. The gap between these two realities is where the opportunity and the danger lies. We have a stock that just closed at $3.14 after a brutal week, yet it has $250 million in fresh cash and a partnership with Microsoft that is moving into live production. The expectations are low because of the recent price action, but the reality of their 13 billion API calls tells a different story. We are watching a company try to build the indispensable infrastructure for the next decade of commerce, and right now, the market is giving you a chance to look